Alright, hi guys, so this is my first video for the new year and I'm going to begin by talking about my top 5 stock market forecast for 2023. What do I expect is going to happen in the markets this year? So before I begin, always remember that no one can predict short-term stock market movements or no one can predict the economy with absolute 100% certainty because there are just too many unknown variables, there are too many moving parts, and we can't predict tomorrow's news or next month's news. All we can do is to look at the current facts right now and to make probabilistic guesses on what's most likely to happen based on current facts. But of course, markets are dynamic and you must be prepared for the fact that anything can happen in the markets. Always know that ultimately my investment and trading decisions every day have got nothing to do with my economic and market forecast. For example, when it comes to investing, every year I set aside a certain amount to invest into the best companies in the market. As long as I identify companies that meet my investment criteria, they've got very predictable sales, earnings, and cash flow. They've got high return on capital. They've got strong operating margins. They've got a sustainable competitive advantage, high growth potential. I will buy shares as long as the price is attractive. In other words, it is undervalued. If I can get a good margin of safety, I will consistently buy shares of high quality companies, regardless of whether I think that this year is going to be bullish or bearish, regardless of whether I anticipate whether interest rates are going to rise more or less. Because it doesn't matter. In investments, I take a multi-year investment horizon. And I know that when I invest in great companies today at a discount, over time, they're going to deliver huge returns in my investment portfolio. And every day I look for high probability trades to take, both option trades and stock trades. And again, my economic and market forecasts don't influence my trading decisions. My decisions to trade are based on finding stocks with high relative strength and entering when I see the appropriate technical patterns, like when the price is breaking out of a consolidation pattern or breaking out within a base pattern. These are the things that we teach in the course and I've shared on YouTube as well. So with that in mind, let's run through my 5 top market forecasts for 2023. Now, of course, the first question that everybody would like to know is 2023 going to be another bearish year? Are we going to go lower, or is it going to be a bullish year? Now, I don't have a crystal ball, but I can tell you that statistically, we are more likely to have an up year than a down year. Now, for 2023, we actually have more than an 85% probability of ending the year with a gain. If you take a look at the last 95 years of the US markets, this is from 1928 to 2022, you can see that they were altogether 73 years that ended with a gain. We call them the bullish years. And these are the ones that are over here. So let me kind of like highlight this entire group. These are years that ended with a gain. And they're altogether 73 of them. And these are all the years that ended with a loss on the left. And they altogether 22 of them. So in fact, last year, in 2022, the S&P 500 fell 19%, which is within this category over here. There we are, that's 2022. So statistically, if you take any given year, the chance of it being up is 76%, and the chance of it being down is 23%. So the odds are always in your favor as a bull. When you're bullish on the market on any given year, you're going to be right a lot more than you're wrong. But when you are a bearish person, you're going to be right once in a while, but in the long run, you're going to be wrong most of the time. And that's why I choose to be more bullish than bearish most of the time, because then I'm right most of the time, and that has been my secret of creating a lot of wealth in the markets. Now, specifically for this year, 2023, the odds of it being bullish are even higher than 76.8%. Why? Because last year was already a negative year. So if you take a look at this chart, you can see that after a negative year, the chance of the next year being negative is actually pretty low. In fact, in the 21 instances where markets declined, only 3 instances did the market decline again the following year. This happened in 1974, the year I was born, 2001, and 2002. In other words, the chance of you getting 2 negative years are about 14%. But after a negative year, the chance of the next year being positive is 18 out of 21, which is about 85 0.7%. So from a statistical perspective, I would forecast that 2023 will be a bullish year. Now again, is there a chance it could be a bearish year again? Of course, there's a 14% chance. But so what if it happens? Is it the end of the world? Is it a bad thing? Not really. In fact, after 2 bearish years, if that really happens, then the years that follow will be even more bullish. So the point is to stay invested into high quality companies, keep buying shares of great companies, and when the bull market comes, you're going to get huge returns. Now remember that we are currently within a secular bull market. I've mentioned this before. In fact, we are halfway through the secular bull market. Secular bull markets last anywhere from 16 years to 20 years. We're right now at the 9th year mark. We are halfway through. And you can see that last year we went through our second cyclical bear market. You can see 2 bear markets, cyclical, secular bull market continues, 2 cyclical bear markets, bull market continues. So once this cyclical bear market ends, you can expect the secular bull market to continue for at least another 6 to 10 years. Next, almost every mother, father, son is predicting that there will be a recession in 2023. In fact, you can see that out of 60 economists and forecasters, their median forecast is a 65% probability of a recession this year. But there's a wide range of forecasts. Again, on one end, you've got like Bloomberg, Bank of America, giving a 100% chance of a recession. You've got some other economists giving a 20% chance of a recession. And Goldman Sachs, that compiled this data, is forecasting a 35% chance of recession this year. So how about moi? All right. So as far as I'm concerned, I'm in the camp that there'll be no recession, or if there is a recession, there'll just be a mild recession. So that's my forecast. So why do I think that there'll be no recession or just a mild recession? Well, understand that many people are expecting a recession because of 2 reasons. Number 1, because of the yield curve inversion. Number 2, because they believe the Federal Reserve will have no choice but to raise interest rates to force the economy into a recession in order to bring down inflation. So let me first talk about the first point, which is the yield curve inversion. Now, since 1968, there was a professor called Campbell Harvey, and he developed this indicator that said that whenever the 3-month interest rate went above the 10-year interest rate, the yield curve gets inverted. That confirms a recession. So in other words, when you see this interest rate here, 4.58%, go above the 10-year treasury yield of 3.56%, you can see it's about 2 basis points above. That means a yield curve is inverted. And again, since 1968, this indicator has been right 8 out of 8 times. So this is the 9th time that this indicator is predicting a recession. So why shouldn't we listen to it? It's been right 8 out of 8 times. Because the economist, Professor Campbell Harvey, who invented this indicator, is now saying that his indicator is wrong this year. Okay? So think about it. If the guy who invented this indicator is saying that it's wrong, maybe there's something to it. So why does he say that his indicator is not right this year? 2 reasons. The first reason is because he argues that although the yield curve has inverted, but this time the labor market is extremely strong. And this is an argument I made before. Now remember that 70% of US GDP comes from consumer spending. As long as people have jobs, people are employed, they can spend, the economy can't go into a recession that easily. And that's what's happening right now. As of the last jobs report, Friday, 6th of January, the unemployment rate dropped again from 3.7%. The unemployment rate is now 3.5%, which is one of the lowest in the history of US employment. And there still is this big jobs workers gap. In other words, there are more companies looking for workers than actual people needing jobs. So even people who get retrenched from the technology sector right now, retrenched from Amazon and even Goldman Sachs, they can find jobs very easily because again, there's a lot more openings than job seekers. So as long as, again, there are jobs available, people get jobs, they can earn money, they can spend, it's going to be hard to get into a recession. And that is the professor's take on it, which is something I've mentioned before. The second argument the professor makes is that his model of yield curve predicting recessions is based on inflation-adjusted yields. A lot of people are making the mistake of looking at the nominal yields, which means not taking into account inflation. So if you just take a look at the nominal yields, yeah, the 10-year yield minus the 3-month yield is negative. So the yield curve is inverted based on nominal yields. But if you actually adjust for inflation, inflation is currently very high, it's coming down. If you adjust for inflation, you can see that inflation-adjusted yields, 10-year minus 3-month, is actually still very positive. In other words, the yield curve is not inverted if you account for inflation-adjusted yields. And that's why the professor is saying that his predictor or his yield curve indicator could be really wrong this year, and he's not calling for recession. Now, currently, if you look at the real-time data, the US economy is still extremely resilient. The current live GDP growth estimates for Q4 of last year is now at 3.8%. So GDP for Q4 of 2022, which was last quarter, is still at 3.8%. We just got Friday's job report, and it was a very, very good report. And that's why the market went up on Friday, which was last Friday. So what happened? Number one, we had non-farm payrolls increased by 223,000 for December. That's above the 200,000 estimate. So what does that mean? That means the US economy is still creating jobs. It created 223,000 jobs in December. And again, if the economy keeps on creating jobs every month, it's going to be hard to get into a recession, right? Next, unemployment rate, like I mentioned just now, fell from 3.7% to 3.5%. So unemployment is again, not going up. Now, the other good news is that wage growth is growing less than expected. Now, remember, one of the things that's causing this high inflation is that wages are going up too fast, and wages are creating sticky inflation, right? So on Friday, what happened was that wages was shown to have grown 0.3% month on month and 4.6% year on year, which is still growing. Wages are still growing, but lower than expected, and it's decelerating. So if you take a look at this chart over here, you can see again, year on year, change in average hourly earnings have been decelerating. And that is a great piece of news for the fact that inflation is beginning to slow down. So again, US economy is strong, but people say the Fed will have no choice but to keep raising rates to force a recession in order to bring inflation down. So that comes to my third forecast. And my third forecast is they don't have to. The Fed will probably start to pause or raise slower, but they will raise less aggressively, because my forecast number 3 is that inflation has peaked and the 10-year treasury yield has also peaked. Now, over here you can see this is the inflation rate of the US year on year. We have peaked and it's beginning to decelerate, right? The 10-year treasury yield over here, you can see peaked last year, and while it's still above this trend line, it's beginning to make lower lows, and there's a chance that it may consolidate, but it probably has already peaked. Now, why is this important? Remember, I've said this before, that the main reason why the market dropped last year, the bear market went down, not because of a recession, not because of earnings contraction, right? Companies are growing their earnings, although slower, economy is growing. The only reason the stock market went down is because of the rise of the 10-year treasury yield, which compresses price earnings multiple. So if the 10-year treasury yield can continue to be flat or go down, and inflation remains moderate, then this year will be extremely bullish. So why do I think that inflation has peaked? Well, all the main drivers of inflation 2022 have all collapsed, right? Look at gasoline prices down 40%, crude oil down 36%, and they are below the pre-Ukraine war levels. Check it out, right? So Ukraine war started early in 2022, gas went all the way up, and now it's below 2022 start of that year, right? Same thing with crude oil prices, went all the way up and then collapsed. What else? Wheat, agriculture, right? Wheat prices are down 45%. The Baltic Dry Index that measures shipping, and shipping, high shipping costs has been one of the main drivers of inflation. Shipping prices are down 55%, below the 2022 level when it first started. So my expectation is for core PCE inflation, which is the Federal Reserve's preferred inflation data. I expect it to slow from 4.7% this year to 3% by late 2023. Another reason why I think inflation is definitely coming down is because if you look at the M2, which is the money supply, you can see that it has come down significantly. The rate is the money supply plus inflation. And if you look at historically, money supply has always been a leading indicator of inflation. You can see when money supply comes down, inflation comes down, money supply comes down, inflation comes down, money supply goes up, inflation goes up, and now money supply has really gone down significantly. In fact, its biggest decline since the 1960s, if I'm not wrong. 1960s? Yeah, like 60 years, right? Biggest decline in 60 years in the money supply. So we can expect, again, inflation to really moderate. And as long as inflation moderates, the Fed does not have to keep raising rates so aggressively. They may still raise rates, but at a more gradual pace. Now, the only risk that could cause inflation to reignite is actually China's reopening. As you know, that China is now reopening. It's abandoned its COVID-0 policies, it's opened its borders, and now Chinese people are going to fly all around the world and consume and buy, right? So on one hand, that could, cause oil prices to go up again, that could cause global demand to go up again, that could spike inflation up again, right? That's the bad news. But on the other hand, by China reopening, it is easing the supply chains. So things are moving faster in terms of the supply chain, so that is deflationary. So the inflationary effect of China reopening would be counteracted by the deflationary effect of easing supply chains. My fourth forecast is that the Chinese stock market has entered a bull market, and the bull market is only at its beginning stages. Thanks for watching. I'll see you guys in part 2 of this video. Be sure to subscribe so you get instant notifications once the next video is ready. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.